Hello, everybody. As participants, I see you're coming in. Welcome to the FEI Long Island webinar, the proposed tax changes plan ahead, as you can see on the slide right here. Yep, good. We're getting a good, nice flow of people in. I just want to give a brief intro. We would like to thank our sponsors at FEI Long Island, our platinum sponsor, Robert Half, the gold sponsors, Citron Cooperman, MetLife, Nixon Peabody, and of course, BDO, who's running the program today. I'd like to remind people to please complete the polling questions and the post-event survey so that you can get your CPE credit. And so, without further ado, Peter Diakovasilis from BDO, please take it away.
Thank you, and thank you for pronouncing my last name right. So Peter Diakovasilis, I'm a partner in the Core Tax Services Group in the New York metro area here at BDO. I've been with the firm for more than 14 years, and my experience is with respect to corporate tax, multinational businesses, multi-state businesses, publicly traded, privately held, in various industries. And today's topic of discussion, or our agenda for today, we will be discussing various tax legislation proposals. And throughout the entire year, there's been a numerous amounts of versions with respect to these proposals. I'm going to kind of walk you through them all, and with some of the recent modifications as well, issued back in, or a couple of days ago, 2 weeks ago, November 3rd. And also we'll be discussing some planning considerations. Chris, before we start going into the program, could you put up the first polling question?
There we go.
So if you can see it, I'm a New York Jets fan, and just trying to see how many people, what they think about the New York Jets this week versus the Miami Dolphins. Guess give somebody just a few more minutes or a few more moments. I don't know, Chris, how are we looking in the participation? Is everybody bashing the Jets or what?
Yeah, kind of. I'll post it. We're at 88%. There's two folks who haven't answered it, but I'll give them a moment.
Okay.
Or that might be you and I.
It says we're not allowed to vote, so
oh yeah,
then we're good. Okay. All right, so, and there's the statistics. We have 38% claim that they are going to win, 44% no. There is that 6% folks that they don't know who the Jets are, which I can agree with in some, in some state reform. And then there's a couple of maybes as well. I think they're gonna lose, but what the hell do I know? I'm a New York Jets fan. Anyways, so moving on and discussing the federal tax legislation proposals. Now, just want to make sure that everybody is aware that there's a lot more proposals out there that we will be covering for today. Given the time frame, I'm going to be covering some of the key areas that I think most companies will be facing and figuring out, along with discussions with their tax advisors on, in terms of their overall tax, their tax plan moving forward. So here I have a nice little chart that identifies a couple of key proposals and methodologies with respect to these proposals, along with what the current tax law that we have as of today. From the income tax perspective, the corporate rate is currently a flat tax at 21%. And throughout the entire year, there's been some juggling as to where the direction of the corporate tax rate was headed. Under the Green Book proposal earlier in the year, it was expected to rise up to 28%. And then recently, the House Ways and Means Committee proposal had requested that it would come up to an incremental tax rate, at the highest rate being at 26.5%. The Build Back Better plan did not have any sort of issue with this, no provision at all. But with some recent amendments to the plan, it looks like it's reverting back to the current tax law that we have at 21%. Still, this is still in proposed phase, and we might see some additional modifications to this. But as we stand here and talk to you today, the current proposal for the tax rate will remain the same at 21%. However, the next line item here identifies a new minimum tax on book income of certain corporations. The proposal that has been proposed on this is looking to bring back the corporate alternative minimum tax, which is based on a 15% tax rate on adjusted financial statement income, which is really targeting companies that have income over $1 billion. This policy wouldn't be effective until 2022, but it is something for the large corporations to consider when it comes to their planning. We don't know what to expect right now with any sort of substitutions, but currently we understand and expect that this is still in play. Okay. So another key consideration too is the research and experimental expenditures and the 1202 stock rules as well. For tax years beginning after 2021, all US-based and non-US based R&E expenditures, which is governed under Section 174, will be required to be capitalized and amortized over a 5-year and potentially a 15-year period, respectively, for beginning for tax years after 2025, which is the current law. The expectation is that that will remain in effect, and companies that produce or incur lots of research and experimental expenditures are going to be required to capitalize and amortize them versus being able to deduct them currently as we stand as of today. This will obviously increase the tax base of a taxpayer currently, which in some situations might be beneficial, but in most situations it may not be, as we're deferring the deductions. For the limitation on qualified stock, unqualified small business stock, the current proposal that we have as of today would eliminate the 75% and the 100% exclusions for the sales of QSBS stock acquired after February 17th of 2009 and sold after September 13th of 2021, unless the sale was made to a written binding contract that's already in place and not materially modified thereafter. The proposal would also apply to taxpayers whose adjusted gross income exceeds or equals to $400,000 or more, and to trusts and estates. Under the current 50% exclusion rules, the remaining 50% QSBS gain is expected to be taxed at a 28% rate. The excluded QSBS gain is considered an AMT preference item, which, when considered along with the net investment income tax, which we'll talk about in a minute, on taxable income, half of the gain, the result of the effective rate is going to increase significantly. So a lot of things to consider with small business owners that have their stock considered as QSBS stock. So it's something for high net worth individuals that have these businesses to be mindful of. There's other considerations here as well to consider. The first line item deals with publicly traded companies with respect to the Section 162 limitation, which currently limits the amount of compensation that a publicly traded corporation can deduct on certain key principles. The current proposals are looking to enhance and enhance who would be considered a covered employee. So currently we're up to 5 employees. They're looking to increase that to almost the highest 8 compensated officers of the company. So they're doing that through adjustments to some of the aggregation rules that could apply to Section 162M, but something to consider if you're a publicly traded company, that most likely more of your compensation paid to your highly paid officers could be subject to limitations. This proposal would be effective for tax years beginning after 2021, so it gives you some time to consider and plan ahead for it. The WOTC, or the Work Opportunity Credit, is expected to increase to 50% for the first 10,000 in wages through December 31st of 2023 for all WOTC targeted groups, except for summer youth employees. The WOTC would also be extended to include the second year of employment as well. There are other key items here as well. The one that we're not going to cover in detail, but is going to be high on the list of most companies, is these new tax credits and incentives that are going to be out there. These credit and incentives are geared towards the new ESG movement for companies looking to invest in more clean energy, sustainability, and other types of programs in that manner. So unless you're having a taxpayer or a company that's looking to invest in, say, solar and wind facilities or any sort of clean energy products, there could be some opportunities to help reduce those costs for those investments through these credits and incentive programs. So with that, Chris, do you want to put up the second polling question?
Yes.
If you choose 0, I don't think that's realistic, by the way.
All right, I can show it.
Please. So I didn't cover this yet, but I wanted to see how many people were paying attention with current events, and it looks like the majority of the people on the call chose the right answer. It is 37%. The 39.6% was proposed, but as I mentioned before with the corporate tax, had been kind of taken away and brought back down to the drawing board. It might potentially go back to 39.6 or some other percentage point, but as of today, as we speaking today, the current income tax rate for individuals, the highest marginal rate, will still be at 37%. However, that may not be the effective rate, and we'll talk about why that could be higher, but the highest marginal income tax rate is currently 37%. So with that, as I mentioned before, the marginal rate was proposed to move up to 39.6%, but as of the recent amendments that have been put out there, under the substitute amendment, it is looking that the rate is still at 37%, the highest marginal rate, but it's possible that from today through the end of the year or somewhere in between, that the rate might be modified once again. So stay tuned on that. However, the one proposal that has not changed is this new surcharge that the government is looking to impose on certain high net worth individuals. I don't believe they have a name for it yet other than calling it the surcharge, but this surcharge would create a new 5% surcharge on an individual's modified adjusted gross income in excess of $10 million, $5 million if you're married filing individually or married filing separately, and then an additional 3% surcharge for a total of 8% on a taxpayer's modified adjusted gross income in excess of 25 million, 12.5 if you're filing separately. For individuals, modified adjusted gross income means adjusted gross income reduced by any deduction not taken into account in determining adjusted gross income, allowed for investment interest or business interest. This modified adjusted gross income does not include any below the line deductions, which the most popular one is charitable contributions, or mortgage interest deductions, or the state and local tax deduction, which right now is currently limited to $10,000 per individual. In addition, for those business owners, if you're eligible for 199A, the 199A deduction or the qualified business income deduction is not factored into this at all, meaning your income base would be higher for purposes of this surcharge, which would be subjecting you to more tax at the end of the day. This tax would also apply to a non-resident alien individual, but only to the extent that their income is effectively connected within the United States. And this tax, this surcharge, is expected to be effective for tax years beginning after December 31st, 2021. The other hot topic that everybody was speaking about or considering with respect to proposed tax law changes is capital gains. And as of today, there's a sliding scale with the highest marginal rate for capital gains is at 20%. However, the Green Book had proposed to make capital gains be taxed at the highest marginal tax rate if the AGI equaled $1 million. The House Ways and Means Committee proposal back in October was looking to increase that capital gain rate from 20% to 25%. But looking back now under this new amendment that we have, it's still, the proposals have been removed and we're still looking at a 20% highest marginal tax rate for long-term capital gains. However, with the surcharge that is still going to probably be in play, those capital gains could be subject, depending if you sell a business or any sort of appreciated assets, they could, depending on the value and the dollar amounts, could be subject to a 28% tax rate at the end of the day. The other surcharge that has been in play for a couple of years now is the net investment income tax. This net investment income tax imposed a 3.8% tax on the lesser of net investment income or the excess of certain income thresholds of 250 if you're a joint filer or 200 if you're single. Now, this tax had some exceptions that if you were a business owner and you sold your business, or if you had income from your trade or business, you could avoid having that income be subject to this net investment income tax. Under the current proposals, the proposals would remove these carve-outs and otherwise exclusions for purposes of trade or business income. So if you're a partner in a partnership or you own an S corporation and you have income that's being recognized by you through your K-1s, or if you sell your interest in the company and you're about to retire and you have a large amount of gain, under current law, any income associated with that sale of that business that you have an active participation in, it wouldn't be subject to this 3.8% surcharge. But under the new proposals, they would eliminate this active participation test. They would also provide for some other adjustments as well, but that is the biggest criteria that would be affecting most taxpayers, if not all taxpayers. So just be on the lookout, as we still don't know what to expect, but that is the current proposal that is out there, the Ways and Means Committee under the BBB plan. Another new topic as well, but unfortunately, or fortunately for most taxpayers, they've been dropped under the current House proposal, is the taxation of carried interest. I know that a lot of people have been talking about this for years, especially in politics, but the holding period was being proposed to increase to 5 years versus 3 years in terms of a carried interest. They were also looking to expand the taxation for certain carried interest by basically adjusting it entirely as a ordinary income for taxpayers that have over 400,000 of income. But as of today, this proposal has been removed and is not on the table as of yet. But stay tuned that this is a hot topic in today's tax world, that there's going to be some sort of modifications to the current carried interest rules. Also, the 199A deduction that was implemented back in 2017 under the Tax Cuts and Jobs Act, it provides certain eligible income to be subject to a 20% deduction, which is claimed on an individual's tax return. Under the current proposal, or the most recent proposal prior to it being dropped, they were looking to eliminate or limit the amount of deduction if your income exceeded certain thresholds. 500,000 if you're a joint filer, 250,000 if you're married filing separate, 400 if you're single. It was going to be effective for 2022 or tax years beginning after 2021, but as of today, it has been dropped. So stay tuned, as it could come back with some sort of other adjustment. So one of the hottest conversations that I have with friends and family and clients as well is the state and local tax deduction. Here in New York, if you own a home, you make a good wage, you are probably paying more in state tax of 10,000 or more. I mean, property taxes could average anywhere from 15,000 to 30,000, depending on where you live, and even higher. So right now, the Congress has been lobbying for, ever since it was repealed or limited, I should say, to get it back on the table. We now have a bill proposal that would increase the limitation from $10,000 to $80,000, $40,000 in case of an estate trust or married individuals that are married filing separate. This increase to the limitation would be effective through 2023. The current limitation of 10,000 would apply and come back to the table in 2031, which is right before where the limitation was originally supposed to sunset in 2032. This proposal would be effective for taxpayers tax years beginning after 2020. So right now we have a month and a half to go for 2021. The new proposal is looking to make this adjustment effective for the tax returns that all individuals will be filing in a couple of months, which I know a lot of people on this call will be very happy for, especially if you live in New York. Taxpayers with pass-through entity interest could also, or most likely, have been having discussions with their tax advisor, especially if you operate a business in the state of New York. Most recently, the New York State government had enacted a new pass-through entity tax, which could, in a sense, move the geography of the tax that is borne by the individual owners from being below the line, subject to this limitation, to above the line. And what it does is it shifts the burden of who's paying the tax and creating it as an ordinary business deduction that the pass-through entity, S corp or partnership, would be liable for. And from there, your federal income, your K-1 on your federal income would have this tax being baked in there and having it as a reduction in your income without limitation from this $10,000 limitation, or even potentially $80,000. And it also gives you a credit on your New York State return. So in essence, you're basically saving or eliminating or bypassing this limitation. Now, if they increase the tax limit to $80,000, some taxpayers may not have an issue with doing this pass-through entity election. However, some need to consider whether or not they would be subject to the alternative minimum tax. As we all knew back in the day when the limitation was not there, most taxpayers were subject to the AMT because they had high state and local tax deductions. So this pass-through entity tax election still bypasses that AMT preference item and is not subject to any sort of adjustment for AMT purposes. So even though it may not help you from the itemized deduction standpoint, it could still help you from an internal alternative minimum tax perspective. Also, maybe you're a high net worth individual that your state taxes exceed 80,000 too. So another consideration to think about when owning your pass-through entities and making these elections on a New York State or any sort of state tax return that you have as a pass-through entity. Another key issue here that most taxpayers that I know frequently take advantage of is what's known as the backdoor Roth IRA strategy. This strategy currently allows taxpayers who exceed their existing Roth income limits to make non-deductible contributions to a traditional IRA, and shortly thereafter convert the non-deductible contribution to the traditional IRA or Roth to a Roth IRA. Current law allows taxpayers to contribute to a Roth 401k plan regardless of income limits, including making non-Roth after-tax contributions and converting such contributions to a Roth IRA. This proposal would prohibit applicable taxpayers from engaging in these backdoor Roth IRA policies. So it's something to consider if you have any sort of IRA plans and you're looking to fund your Roth IRA and your income levels are high, you may not have that opportunity to continue that strategy moving forward. The other hot topic that I want to bring to your attention too, from an individual income tax perspective, is the excess business loss limitation. Under the temporary provision, excess business losses, or EBLs, of non-corporate taxpayers that exceed $500,000 for joint filers are disallowed and treated as net operating losses in the following year. However, the provision is set to sunset on December 31st, 2026. The proposal would make the temporary provision permanent and modify how a disallowed EBL is treated. Instead of it being treated as a net operating loss in the following year, the EBL would be treated as a deduction attributable to the taxpayer's trade or business when computing EBL in the subsequent year. The third draft further provides that any excess EBLs held by an estate or trust upon termination of the estate or trust would be allowed as a deduction to the beneficiaries succeeding to the property of the estate or trust. This proposal is effective. This proposal would be effective for taxable years beginning after December 31st of 2020. So in essence, it's moving the geography of the EBL carry forward. Currently, the NOLs would not be subject to this EBL rule, but the proposal is looking to bring it back into the EBL rule consistently year over year over year. The other three bullets talk about estate planning. Right now, all these were proposed to impact estate planning purposes, but right now, the current proposal, the way it stands, has dropped all three of these items. So in terms of estate planning, this is a good win, but I still suspect there'll be some sort of consideration or adjustments with respect to these sort of items. So stay tuned. With that, Chris, could you open up the other polling question? Chris, how are we doing with the polling questions?
Good. Right now we're at 57% for answer for this. Just seeing if anybody else is looking to answer the polling question. Oh, I'm going to share the results.
So I think everybody was paying attention. One person either misclicked or wasn't paying attention. The answer is $10,000, which what we have as current law today. We are expecting or in hopes that it would raise to 80,000, but it's still TBD for now, unfortunately. And as I mentioned before, the proposals that we have on the plate today, they might very well change again by the end when it's all said and done. But we do know that the state and local tax deduction, it is a hot topic, especially for states that have high cost of living, like here in the state of New York, California. So other states may not have not so much of an impact, like the state of Florida, as there's no state income tax there, but it is expected that there'll be something impacted or changed here, but who knows where the end result will be. Okay. So now, with some of these proposals that are looming and whether they've also been taken off the table, there might be some other considerations that could come back. Whenever we have any sort of modifications to the rules with respect to tax law, as a tax advisor, the first thing that comes to mind, in my opinion, would be a choice of entity analysis. What type of entity do you want to be when you grow up? So back in 2017, when the TCJA was passed, we had a lot of conversations with clients that we were talking to them about with respect to choice of entity. And once the dust settles with respect to the tax law changes and there's modifications to the rates and to all these different nuances, this is going to be a hot topic that most taxpayers and companies are going to be having with their tax advisors. The first slide here talks about some of the decisions with respect to corporations. Back in 2017, based on the tax law, some pass-through entities felt that converting to a C corporation was in their better interest. The spread of 16% rate between the corporate tax rate of 21% and the highest marginal tax rate of 37% was just one of the key factors that drove that decision for most taxpayers. Originally, we were speaking a week or so ago, or 2 weeks ago, I should say, before November 3rd, the Build Back Better plan had different plans with respect to the tax rate for corporations. But as we're speaking today, that plan is off the table right now. It's been dropped. But the Biden administration does have desire to increase the corporate tax rate so that 16% spread is most likely going to shrink eventually. I'm sorry, is going to be adjusted eventually. So evaluating the net spreads becomes more complicated when considering two levels of tax in a corporate setting versus one level of tax for individuals that receive K-1s from flow-through entities. So this is the whole concept between the two levels of tax, so the double tax with respect to C corporations. So that's another consideration that needs to be evaluated when making a decision to switch to a C corporation. So if your fact pattern for your business meets this criteria, it could make sense. Meaning, if you're a C corporation, if it would make sense for you to be a C corporation if you're looking to reinvest after tax profits in pursuit of growth, or any sort of other as a second layer of tax that applies to the dividends at the shareholder level will not be incurred. Meaning, if you have plans to grow and you want to take those profits and fund them for your future growth, you can avoid that second layer of tax on your shareholders for distributing out the earnings and the dividend tax. It is also important to note that there is no basis buildup for undistributed earnings in a C corporation, whereas if you're a pass-through entity and you don't distribute the earnings, your basis increases. So it's just one thing to consider. A C corporation that regularly distributes its earnings, the effective rate under current law is at almost 40%, which if you're looking at the arithmetic, you take the 21% tax rate, plus you have the state tax benefit, plus you have the state taxes, plus you have the qualified dividend income of the 23.8%, which Dividends are subject to a 20% tax rate, plus they're subject to a 3.8% surcharge no matter what. With pass-through entities, they are typically not subject to an entry-level tax. Instead, the tax is paid at the owner level. Pass-through entities typically include sole proprietorships or Schedule Cs, partnerships, and S corporations, which provide their owners, whether they're their partner or they're a shareholder, they'll provide them with the K-1. Pass-through owners with income over 200,000 or 250 if you're married, who are passive with respect to the pass-through entity, pay an additional 3.8% surcharge for the net investment income tax on their share of the pass-through income. Under current law, that taxpayer can pay a maximum overall tax rate of about 41%, 40.8, if you add the 37% plus the 3.8% surcharge. Or if you're eligible for the QBI deduction, it could be as high as 33.4%. Under the buy-in plan, currently, those rates are expected to be the same, but under the original plan of increasing it to 39.6%, they would be higher as a result. On top of it, they would also add those additional surcharges as well, depending on how much income that taxpayer makes. So that effective rate of 40.8 would increase as a result. S corporations is a very popular strategy currently for alleviating self-employment and Medicare taxes. As right now, current law, S corps are not subject to it. They're exempt from these types of taxes, unlike the partnerships, the LLCs. So if you're an S corp shareholder and you own an operating business, the flow-through income, it's not subject to this self-employment tax. However, the shareholder on the S corp should pay themselves a reasonable salary so they can be subjecting themselves to some sort of compensation and funding Social Security and Medicare. It doesn't necessarily have to be the entire amount of pass-through income, but there needs to be some sort of reasonable salary that's paid to the owners. As I mentioned before, if you are a passive owner of an S corp, you will be subject to the net investment income tax on your pass-through income. Under the Build Back Better plan, the net investment income tax cannot be escaped for active owners making $400,000 if you're single, or $500,000 if you're joint filers. So that will add more surcharges to business owners of an S corporation. While S corporations are less flexible than partnerships or LLCs, and some of the examples here would be fixed income, loss allocations, you have a requirement of one class of stock, there's certain ineligible shareholders that you'd have to follow these requirements. It is only the choice when potentially converting from a C corporation to avoid a taxable liquidation and 2 levels of tax. So from that, in comparison to partnerships, there's a little bit more benefits there, but they do come with other disadvantages as compared to the partnership route. Partnerships are the most flexible and user-friendly business entities, since these vehicles subject owners to only one level of tax. Same thing applies with S corps. They allow property contributions and distributions without immediate taxation. They do permit 2 or more classes of equity interest. They allow for special allocations of income or loss, pending, any sort of economic arrangement that the partners have amongst each other. And there is some flexibility with respect to a future exit for the company, whether it's an asset sale, up-C, up-SPAC IPOs, which is up for another conversation at another point in time, but it's very complicated. But there's a lot more flexibility when it comes to the exit of a company. Unfortunately, a conversion to a partnership from a C corporation would be treated as a taxable liquidation, subjecting the current value of the business to 2 levels of tax upon conversion. Whereas an S corp is still a corp, and converting from S status to C status, it will be, which I mentioned before, you avoid that two levels of tax. One consideration to avoid this could be a conversion to S status while contributing the business to a lower tier partnership, which other investors could invest into directly. We've seen that from time to time, but everybody's fact pattern is different with respect to what they can and can't do. So, is it beneficial to switch from a C corporation to an S corporation? This switch back to S status is only allowed once every 5 years, or is allowed once 5 years has lapsed, I should say, from the business's S termination or the revocation year. So if you make that switch, you can't re-switch back and forth every subsequent year. There's a 5-year waiting period that you have to kind of let lapse before you can make a new decision if you want to move back and forth in your respective tax-paying statuses. With respect to an S corporation, there is one level of tax on income at the shareholder level with certain exceptions. Under the Tax Cuts and Jobs Act, the company will be subject to a potential 29.6% federal income tax rate after taking into consideration the 20% deduction under the Qualified Business Income Rules 199A. Compensation of S corporation shareholders are considered W-2 wages for determining limitations of the qualified business income deduction. So that helps boost the opportunity to take advantage of the 29% deduction. A single level of tax on income conserves cash for a growing business in the S corporation status, which reduces the need for, say, bank loans and the cost of additional interest that decrease the earnings of the operations. The longer benefit is a buildup of outside basis in the event of a future sale of the stock, whereas in the C corporation route, there is no buildup in any sort of basis of your stock. Under the current taxing regime, S corporation shareholders that materially participate, I think I mentioned this before, could avoid the net investment income tax, but it is expected under the new proposals that that's going to go away in the future. So, other important considerations to consider with respect to being either a pass-through or a C corporation is if you're a shareholder or an owner, are you taking current distributions versus are you trying to reinvest the after-tax cash into your business for growth potential? That's a consideration you think about. Also, the expected rate of return on the reinvested cash. What are you looking to get out of it? Are you looking to plan and grow, which can help future, cash flow or revenue streams, or are you investing it elsewhere? Potential exit events and timing considerations is a key consideration to think about. The availability of the 199A deduction, which is currently still in play at the moment, which helps reduce the effective rate of the taxpayer at 20%. While this is also a hot topic in the proposals, I just don't have the time to cover it, but there are key international tax considerations to think about when dealing with being a pass-through entity or C corporation. The one that is the most common or acronym thrown around is the GILTI regime, which is basically a deemed dividend repatriation regime that requires C corporations and pass-through entities to, in a sense, deem them to distribute the earnings from the lower tier subs in foreign countries, even though the cash never really came back up, and subjecting the company and ultimately the owners from the pass-throughs to tax on income they never technically received. In the corporate context, there's some other benefits to there where you can help mitigate that tax effect, whether it's through a dividends received deduction or a FEI, foreign tax credits. There's just too much to talk about, but those are the key considerations to think about. And also impact of other aspects of tax reform on taxable income as well, with respect to the research and experimental deductions or anything of the like. So here is a nice chart that just covers federal taxes if you, the business owner, own a corporation under the Tax Cuts and Jobs Act. You'd be subject to a 21% rate. If you were looking to distribute the earnings, you are taking a tax effective rate on your overall earnings of almost 40%, 39.8%. There is no benefit for 199A, So that's why that's 0. And then you have the net investment income tax. You also have the taxation on the dividends that you have to consider. Notice on the pass-through entities, the dividends, the net investment income tax line items are 0. Now, under the active S Corp, the net investment income tax is not applicable, but for passive owners, it is applicable. So if you are a active owner in a business and you have your business operating through an S Corp, you could potentially only be subjecting yourself to 29.6% of federal tax rate under current law, which is almost about just a little bit north of 10%, 10.2% of the corporation versus the active S Corp effective rate. If you're passive, you would be subject to that extra 3.8% surcharge. So your tax rate effectively would be about 33.4%. So these slides were built prior to the tax rates being dropped, but I kind of left them here just to illustrate if the tax rates were to go up, how would it impact, or just to reflect a percentage point of how it could impact taxpayers. So if the Build Back Better plan, the 26.5% rate would, the House Ways and Means, the original plan would be there effectively, the highest marginal rate would be at 26.5%. The effective rate for the distribution would be roughly 18%, as capital gains would be subject to a 25% rate, plus the net investment income tax. Effectively, your income, if you were a C corporation and you pulled out the earnings, your tax rate would be almost just shy of 50%, 47.7%. In the pass-through entity world, if you were an S Corp, notice that there's no active or passive. It's all now subject to the same tax rate. It would be subject to a 39.6%, 3.8% surcharge, 43.4%, no tax on distributions or net investment income tax after the fact, because we already factored it above, and there's no 198 deduction, assuming you make over 400,000. So in a sense, the effective rate, if you're an active business owner as an S corporation, I'm going to flip backwards one slide, 43.4 versus 29.6. So that is a significant increase in effective rates under the old regime, under the Tax Cuts and Jobs Act versus the Build Back Better plan. So current distribution reinvestment of cash is an important topic when considering your choice of entity. The lower corporate tax rate it creates an additional value for after-tax cash versus pass-through entity cash and after-tax distributions, meaning if you are at a lower tax rate, you can help reinvest those earnings, right? You can also plan to use excess cash flow, current distribution, reinvestment. It can help impact your future enterprise value. Rate of return and time horizon for exit strategies will have a significant impact on net after-tax cash to investors, and immediate distribution of cash, unlikely to create a situation where incorporation is advantageous. So 199A, as I mentioned, right now it's dropped, but there's still some considerations to remove it again. However, under the current law, TCJA, the tax deduction, this 20% deduction, haircuts your effective rate down to 29.6%. It only includes domestic income, not foreign income. It has to be operational income here in the United States, or effectively connected income is the terminology used. There are potential significant limitations based on the type of income. I mentioned before, it's only eligible for qualified income. There are certain type of income that's no good. If you're a CPA or a lawyer, you know what I'm talking about. Your income is no good for this purpose. These complex rules were set to expire for tax years beginning after 2025. And as I mentioned, the Build Back Better plan had intended to eliminate it if you made too much income. And that too much income is 400,000 or more. Some other considerations to think about: if you convert from a C to an S, they're generally tax-free. There's some considerations to think about that could spark some tax: the built-in gains tax, 1374, 1375. LIFO recapture, I mean, that's not, in my experience, that's not very common, but they're out there, and they could have a toll charge on the corporation converting to an S status. The one big nuance that S corporations have that are unfavorable as compared to the other flow-through entity partnerships is there's a limitation on how much shareholders you can have, 100. And yes, there is some flexibility that for this 100 rule, a husband and wife or certain related parties are considered one person. So in essence, you can have more than 100 under the related party rules, but it is limited to 100 shareholders. An S corporation only has one level of one single class of stock with sole voting rights being ignored for this requirement. So in terms of the partnership world, where I see a lot of, there's certain economic arrangements where people, I guess, receive preferences and cash flow. In S corporations, that's not allowed. Income needs to be divided evenly on a per day, per share basis. Also, shareholders of S corporations can obtain the 20% deduction, which there's limitations. The limitations is subject to the 50% wage of how much your business has paid to its employees, or a 25% of the wages plus 2.5% of the unadjusted basis of all your fixed assets that you have within the United States. And then finally, here's a nice little summary chart. I think I mentioned these a couple of times. There's some things that we didn't discuss, but here's a nice summary and pros and cons, why you should convert, why you shouldn't convert to S status. S status is a hot entity type now, considering the new tax law changes, but it may very well be that if Congress huddles up again and makes further modifications, there could be some more modifications to skew this, but a lot of taxpayers, in my experience, have been converting to S status, and here's some of the reasons why you should, and some of the reasons why you shouldn't. With that, I think I have a few minutes left. I don't know if there's any questions or comments.
No questions were put in the poll and in the chat yet.
I think we have one more polling question, Chris, right?
Yep.
Let's do that right now.
All right, here we go. I'm gonna post this and I'm gonna give you the question.
Can we get a copy of the slide deck? So Desiree, unfortunately, because the proposals are everly changing, and I was actually nervous that when I woke up today, I was going to see some sort of shocking news that there's been an additional amendment to the proposals. What Chris can do is share with you a link to our website that has all those charts and information directly on our website. They're there. You can copy and paste it. You can also subscribe to alerts that if there is a change, one day I wake up, our National Tax Office updates those proposals on the fly. So that would be my recommendation if you can sign up. Thank you.
Yep, I just posted in the chat, by the way.
You posted in the chat the link.
The link to your.
Yes. Yeah. So it's BDO.com resources tax policy. Watch with two hyphens in between. Yeah, that would be. And there's a little subscribe button to it. So if you could subscribe, they'll send you all the alerts on the fly. On that website, there's tons of information articles, and also there's more in-depth insight articles that our National Tax Office, including myself, have written on these various topics. Feel free to subscribe to those. And not only do we talk about tax policy changes, but anything related to tax or accounting or advisory with respect to your business. So that insight page is a great tool for valuable information. So the results for the polling question: 4 people chose 10,000, while 9 people chose no cap. And the answer is no cap. So I mentioned before that while the potential limit from 10,000 is expected to increase to 80,000, if you have a pass-through entity business that is a flow, if you have a pass-through entity that is conducting business in a specific state, I use the example in New York because they recently enacted a pass-through entity tax regime. It would be in your benefit to enact that policy or that election to be a pass-through or be subject to a pass-through entity tax to circumvent the income limitation for your federal tax return. You're basically changing the geography of where you put in the state tax deduction. No more on your Schedule A, but it will be a component or built into your Schedule E within your K-1. Now, the states are not going to allow you to claim that as a deduction, so there'll be a modification. But for federal purposes, it bypasses that whole limitation. So the true answer is there is no cap, which is why most states are going this route, especially the states that have a higher cost of living. California enacted it. New York City has been having it for a while. Connecticut had recently enacted it. New York is jumping on board, and other states are jumping on board as well. I don't know if there's any other questions, Chris. I don't see any.
I don't see any other questions either. If anybody's got some last minute burning questions, speak now or forever hold your peace.
Okay. Well, if there's any other questions or comments, please feel free to contact me. I believe my contact, I'll post in the chat here my contact information, or you can reach out to Chris afterwards and he could provide you with my contact information. But it was a pleasure presenting this to you. And I hope by the time I get home tonight, there won't be any more changes because I'll have to relearn it again. But I do expect that there'll be more modifications to these proposals, as it's anticipated there's going to be a lot more back and forth with both Congress, the Senate, and ultimately the president as well. So stay tuned for more changes potentially, but I think the direction that this current administration is headed is to increase taxes, add more surcharges, and impose more taxes that, while it's directed for certain wealthy individuals, could impact the normal everyday individual as well. Okay.
All right.
Well, thank you very much, everybody. Have a great day.
Thanks, everybody.
Bye.